goes. A young worker wakes up, already thinking about transport fare, food for the day, and an overdue bill that has been sitting in their mind for days. The salary is still some days away, but the pressure is immediate. In that quiet moment, the phone becomes a solution. A loan app notification appears, offering instant cash with no paperwork, no collateral, and approval in minutes. It feels like relief. Within a few taps, a small amount is sent into the account, and for a brief moment, the tension reduces. But what looks like a simple financial bridge often becomes the beginning of a cycle that is harder to step out of than it first appears. Digital loan apps in Nigeria have grown rapidly by targeting exactly this kind of urgency. They are designed for speed and accessibility, removing the traditional barriers that once made borrowing more structured and difficult. There is no bank queue, no long approval process, and no physical documentation. Instead, everything is compressed into a mobile experience that feels seamless. This convenience is not accidental. It is part of a system built around fast decision-making, where users are encouraged to borrow first and think later. The psychology behind this behavior is subtle but powerful. When money is presented as instantly available, the brain treats it as a temporary extension of income rather than debt. The immediate relief overshadows the future repayment obligation. Many users do not calculate the full cost of borrowing in that moment. They are responding to urgency, not long-term planning. This is where small amounts, often seen as harmless, begin to accumulate meaning beyond their size. A loan of 10,000 naira, for example, does not feel significant on its own, especially when framed as a short-term solution. But the structure behind it often includes high interest rates, short repayment windows, and penalties that activate quickly after due dates. Once repayment becomes due, a second layer of pressure appears. For many users, the income situation that required the loan in the first place has not changed within days or weeks. This creates a gap between expectation and reality. To close that gap, many borrowers turn to another loan app or reborrow from the same platform. At this point, the system begins to repeat itself. Each new loan is no longer for a fresh need, but to manage an existing obligation. Over time, borrowing stops being a response to emergencies and becomes a method of managing previous borrowing. The mathematics of digital lending amplifies this cycle. Interest rates that may appear small on a daily basis compound quickly when repayment is delayed. Late fees add additional pressure, and the total repayment amount grows beyond the original expectation. What was initially a short-term bridge becomes a growing financial burden. The structure is designed in a way that rewards timely repayment, but becomes increasingly expensive for those who fall behind, even slightly. From a behavioral economics perspective, this pattern is not surprising. Humans naturally prioritize immediate relief over distant consequences, especially under financial stress. Loan apps are built to operate within that behavioral pattern. They reduce friction at the borrowing stage and increase pressure at the repayment stage. The result is a system where access is easy, but exit requires discipline, timing, and financial stability that many users do not have at the moment of borrowing. In the broader financial environment, these apps fill a gap left by traditional lending systems that are often slower and more restrictive. For many people, they are the only available option during emergencies. This is what makes the system complex, rather than purely negative. It serves a real need, but the structure of repayment and cost creates challenges that are not always fully understood at the point of use. Over time, repeated borrowing can affect financial behavior. Planning becomes reactive instead of proactive. Income is mentally divided before it arrives, already assigned to repayments. This creates a sense of constant financial pressure, even when earnings remain stable. The debt is not always large in absolute terms, but its frequency and repetition shape how money is experienced day to day. Eventually, the pattern reveals itself not as a single loan problem, but as a cycle driven by urgency, convenience, and structured repayment pressure. Understanding this cycle does not require fear, but awareness of how easily short-term decisions can link together into longer financial commitments.